The U.S. economy is sending mixed signals. Optimism fights with pessimism. Growth seems possible, but recession casts a long shadow. As of March 16, 2025, the nation is caught in a tug-of-war between positive indicators and looming threats. Consumer confidence has waned, and businesses are wary. Experts debate the likelihood of a recession. All eyes are on the economy, searching for clues about the future. The stock market, often a barometer of economic health, offers a mixed picture. Some indices have shown resilience while others have stumbled. The political landscape adds to the uncertainty. Trade tensions and domestic policies contribute to a climate of unpredictability. Amidst these swirling currents, one thing is certain: economic anxiety is real and palpable. Consumer confidence is a vital sign of economic health. When consumers feel confident, they spend more, boosting the economy. However, recent data from the University of Michigan paints a worrisome picture. Their consumer sentiment index has plummeted over the past 3 months. This decline reflects growing unease among Americans about their financial well-being. The decline in consumer confidence is driven by several factors. Inflation continues to erode purchasing power. The rising cost of living makes it harder for families to make ends meet. This financial strain weighs heavily on consumers' minds. As a result, they become more hesitant to spend, opting instead to save and prepare for potential economic hardship. This decrease in consumer spending can have a ripple effect throughout the economy, slowing growth and potentially leading to job losses. Small businesses are the backbone of the American economy. They are responsible for creating jobs and driving innovation. However, they are also particularly vulnerable to economic downturns. Currently, small businesses face a perfect storm of challenges: rising prices, political instability, and a decline in consumer confidence. The cost of doing business has skyrocketed. Inflation has pushed up the price of raw materials, energy, and labor. This squeeze on profit margins makes it difficult for small businesses to operate and invest in future growth. Adding to their woes, the political climate is uncertain. Policy changes and trade tensions create an unpredictable business environment, making it difficult for small businesses to plan for the future. This uncertainty can lead to hesitation in hiring and expansion, further impacting economic growth. Section 4. Expert Predictions. Recession Probabilities Climb. As economic indicators flash warning signs, experts are increasingly concerned about the possibility of a recession. The financial markets have been particularly volatile, with stock prices swinging wildly and bond yields dropping. This has led to a growing sense of unease among investors and policymakers alike. Economists closely monitor various factors, including consumer spending, business investment, and government policies. Consumer confidence has been shaky, with spending patterns showing signs of slowing down. Business investments have also been cautious, with many companies holding back on major expenditures due to the uncertain economic climate. Based on their analysis, many have revised their forecasts, raising the probability of a recession in 2025. These revisions are not made lightly. They are the result of careful consideration of a multitude of economic indicators and trends. Bruce Kasman, head of global economic research at J.P. Morgan, estimates a 40% chance of a recession this year, up from his previous forecast of 30%. Kasman points to several key factors driving this increased probability, including weakening global trade and rising geopolitical tensions. Up from his previous forecast of 30%. This adjustment reflects the growing concerns among financial experts about the stability of the global economy. Satyam Pandey, senior economist at S&P Global Ratings, places the odds at 25%. Pandey's forecast, while slightly more optimistic, still underscores the significant risks that lie ahead. These forecasts, while not a certainty, highlight the very real risks facing the U.S. economy. The potential for a recession is a topic of intense debate among economists, with some arguing that the risks are overblown, while others believe that the warning signs are too significant to ignore. The reasons for these pessimistic outlooks are numerous. They include slowing economic growth, rising debt levels, and increasing geopolitical tensions. Each of these factors alone could pose a significant risk to the economy, but together, they create a perfect storm of uncertainty. The ongoing trade war with China has been a major drag on global economic growth. Tariffs and trade barriers have disrupted supply chains and increased costs for businesses and consumers alike. coupled with domestic policy uncertainty, has created a volatile global economic environment. Political gridlock and policy missteps can exacerbate economic challenges, making it harder for businesses to plan for the future. Has created a volatile global economic environment. This volatility makes it difficult for businesses and consumers to make long-term decisions, further contributing to the economic uncertainty. Section 5. Wall Street's roller coaster ride. Market volatility signals uncertainty. The stock market, often seen as a leading indicator of economic health, has been on a roller coaster ride in recent months. The dramatic ups and downs have left investors and analysts alike scratching their heads, trying to make sense of the underlying causes. While some indices have shown resilience, others have experienced significant declines. This mixed performance is indicative of the broader uncertainty that permeates the market. This volatility reflects the uncertainty surrounding the economic outlook. Factors such as geopolitical tensions, inflation concerns, and fluctuating commodity prices all contribute to this unpredictable environment. Investors are grappling with conflicting signals, trying to decipher the true state of the economy. On one hand, there are signs of economic recovery such as job growth and increased consumer spending. On the other hand, there are warning signs like rising inflation and supply chain disruptions. The S&P 500, a broad measure of the U.S. stock market, has experienced wild swings. These fluctuations are not just numbers on a screen, they represent the collective anxiety and optimism of millions of investors. After reaching record highs earlier in the year, the index has since retreated, approaching correction territory. This retreat has been fueled by a combination of profit-taking and concerns about future growth prospects. The Dow Jones Industrial Average, composed of 30 large-cap stocks, has also shown signs of weakness. This index, often seen as a barometer of the broader economy, has been unable to maintain its upward momentum. These market fluctuations reflect the nervousness among investors. The constant barrage of news, both good and bad, has created a sense of unease that is hard to shake off. They are unsure about the future direction of the economy and are adjusting their portfolios accordingly. Some are moving towards safer assets, while others are taking a more aggressive stance, hoping to capitalize on the volatility. This cautious optimism is a testament to the complex and often contradictory nature of the current market environment. Section 6. The Trump Trade, Tempest, Tariffs, and Economic Tremors. The Trump administration's trade policies have been a source of significant economic uncertainty. These policies, often characterized by their aggressive stance, have aimed to reshape the global trade landscape. The administration has argued that such measures are necessary to correct what it sees as unfair trade practices and to protect American industries from foreign competition. The imposition of tariffs on goods from China and other countries has disrupted global supply chains and increased costs for businesses and consumers. These tariffs, which are essentially taxes on imported goods, have led to higher prices for raw materials and finished products alike. This has had a ripple effect throughout the economy, affecting everything from manufacturing to retail. While the administration argues that these tariffs are necessary to protect American jobs and industries, the reality is more complex. On one hand, some domestic industries such as steel and aluminum have seen a boost due to reduced foreign competition. On the other hand, industries that rely on imported materials have faced increased costs, which they often pass on to consumers. Many economists warn that these tariffs could backfire, leading to higher prices, job losses, and slower economic growth. The increased costs for businesses can lead to reduced investment and hiring, while higher prices for consumers can reduce spending power. This combination can create a drag on the overall economy, potentially leading to a recession. The trade war with China in particular has had a significant impact on the global economy. The two largest economies in the world have been locked in a tit-for-tat battle, each imposing tariffs on the other's goods. This has created a climate of uncertainty that has affected global markets and trade flows. The two countries have imposed billions of dollars worth of tariffs on each other's goods, leading to higher prices for consumers and businesses. This has not only affected the economies of the US and China, but has also had a ripple effect on other countries that are part of the global supply chain. Higher prices for consumers mean that everyday items from groceries to electronics have become more expensive. For businesses, the increased costs can lead to reduced profit margins and the need to find alternative suppliers or pass the costs on to consumers. This tit-for-tat escalation has created uncertainty and volatility in the global trading system. Markets have reacted to each new round of tariffs with increased volatility as investors try to gauge the potential impact on corporate earnings and economic growth. The tariffs have also hurt American businesses that rely on Chinese imports or export their products to China. Many companies have had to rethink their supply chains, seek out new markets, or absorb the increased costs, all of which can be disruptive and costly. The agricultural sector in particular has been hit hard by retaliatory tariffs imposed by China. American farmers who export a significant portion of their crops to China have seen their markets dry up, leading to unsold produce and financial hardship. This has had a devastating impact on rural communities that depend on agriculture for their livelihoods. Gap 2S Section 7, Consumer and Business Distress. As economic fear sets in, both consumers and businesses are sending out distress signals. The Wall Street Journal recently reported that rising costs and uncertainty are taking a toll on spending and investment behaviors. Gap 1S, consumers, faced with higher prices for everyday goods and services, are cutting back on discretionary spending. This pullback is evident in reduced retail sales and lower consumer confidence. Families are prioritizing essentials, tightening their budgets, and postponing big-ticket purchases. The ripple effects of these decisions are being felt across various sectors of the economy, from retail to hospitality. Gap 1S, businesses, on the other hand, are grappling with increased costs for raw materials and supply chain disruptions. Many companies are finding it difficult to maintain profit margins, leading to cost-cutting measures such as layoffs and reduced investment in growth initiatives. This is particularly concerning for small and medium-sized enterprises which often lack the financial cushion to absorb such shocks. Gap 1S. The combination of reduced consumer spending and cautious business investment creates a feedback loop that can further slow economic growth. As businesses cut back, they may lay off workers, leading to higher unemployment and even lower consumer spending. This cycle of fear and retrenchment can be difficult to break, especially in an already fragile economic environment. Gap 1S. The emotional toll on individuals and communities should not be underestimated. Financial stress can lead to a host of social and psychological issues, from increased anxiety and depression to strained family relationships. As economic uncertainty persists, the need for supportive measures and compassionate policies becomes ever more critical. Gap 1S. As we navigate these turbulent times, it is essential to remain informed and proactive. Understanding the interconnected nature of consumer behavior, business decisions, and economic policies can help us better prepare for and mitigate the impacts of economic distress. Stay tuned for more insights and analysis in our upcoming segments. Gap 2S, end of Section 7. Gap 2S Section 8, Economic Indicators and Recession Risks. In light of the ongoing economic distress, a closer examination of economic indicators reveals a growing concern about potential recession risks. According to a recent report from Axios, several key metrics are flashing warning signs that a recession may be on the horizon. One of the primary indicators is the yield curve, which has recently inverted. This phenomenon, where short-term interest rates exceed long-term rates, has historically been a reliable predictor of recessions. The inversion suggests that investors are seeking the safety of long-term bonds, reflecting their lack of confidence in the near-term economic outlook. Additionally, manufacturing output has been declining, signaling a slowdown in industrial activity. The Purchasing Managers' Index, PMI, a key measure of manufacturing health, has fallen below the critical threshold that separates expansion from contraction. This decline indicates that factories are producing less, which can lead to reduced employment and further economic strain. Consumer sentiment surveys also reveal growing pessimism about the economic future. As more individuals express concerns about job security and financial stability, their spending habits are likely to become even more conservative. This shift in consumer behavior can exacerbate economic slowdowns, creating a self-fulfilling prophecy of reduced economic activity. Business investment is another crucial factor to watch. Companies are becoming increasingly hesitant to commit to new projects or expand their operations in the face of economic uncertainty. This cautious approach can hinder innovation and long-term growth, further dampening economic prospects. While these indicators do not guarantee a recession, they collectively paint a picture of an economy under significant stress. Policymakers and business leaders must remain vigilant and responsive to these warning signs, implementing measures to bolster economic resilience and support vulnerable populations. As we continue to monitor these developments, staying informed and prepared is essential. Understanding the nuances of economic indicators and their implications can help us navigate the challenges ahead. Thank you for joining us in this segment, and we look forward to providing more insights in our upcoming analyses. Gap 2S, end of Section 8.